All right, listen up. You want to know what the stock market is? Forget the complicated jargon you hear from the suits on Wall Street. It's simple. The stock market is a giant marketplace, a massive arena where you, me, and everyone else can buy and sell tiny little pieces of companies. These pieces are called stocks, or shares. When you buy a stock in a company like Apple or Ford, you're not just giving them your money for fun. No, sir. You are becoming a part owner. That's right. You own a slice of the pie. Now, why should you care about owning a tiny piece of a company? Because when that company does well, when it sells more iPhones, more electric trucks, more of whatever it makes, the value of your little piece can go up. Think of it like owning a piece of a local pizza shop. If that shop starts making the best pizza in town, lines are out the door, and they open up a second and third location, what happens? The value of your ownership stake skyrockets. The stock market is the same idea, but on a colossal global scale. We're talking about the biggest, most powerful companies in the world, and they're letting you in on the action. It's your ticket to participating in the greatest economic engine the world has ever known. So you're an owner now. Great. But how does this all work? Let's break it down. People trade stocks for one primary reason: to make money. It's the ultimate goal. We're not in this for charity. There are two main ways you make money. The first is through capital appreciation. That's a fancy term for when the stock you bought for $50 a share goes up to $70 a share. You sell it, and you pocket that $20 difference. That's your profit. To do this, you need a broker. Think of a broker as your agent, your gateway to the stock market. Today, it's all online. You can open an account with an online brokerage firm in minutes from your couch. This whole process is driven by supply and demand. If more people want to buy a stock than sell it, the price goes up. Booyah. That's demand. If more people are trying to sell a stock than buy it, the price goes down. That's supply. What makes people want to buy or sell? A million things. Good news about the company, a great earnings report, a new product, or even just general optimism about the economy. Or bad news, a missed earnings target, a scandal. Your job is to be on the right side of that supply and demand equation. Your goal is to buy low and sell high. That's the mantra. Say it with me. Buy low, sell high. Okay, let's get into the nitty-gritty. The pros don't just throw darts at a board. They study the charts. A stock chart is a visual history of a stock's price over time. It tells a story. And just like in a story, there are recurring themes and patterns that can give you clues about what might happen next. Learning to spot these patterns is like learning to read the market's secret language. These patterns are formed by the collective buying and selling of millions of investors. They represent the psychology of the market, the battle between fear and greed, hope and despair. We're not talking about magic here. We're talking about probabilities. First up is the head and shoulders pattern. This one is a grizzly bear, folks. It's a bearish reversal pattern, which means it often signals that a stock that has been going up is about to go down, and it can go down hard. It looks just like it sounds: a peak, the left shoulder, followed by a higher peak, the head, and then a lower peak, the right shoulder. The key to this pattern is the neckline. When the price breaks below that neckline, especially on heavy volume, that's the fire alarm. There's also an opposite version of this, the inverse head and shoulders. It's the same pattern but flipped upside down. It appears at the bottom of a downtrend and is a powerful bullish signal, meaning the stock might be ready to rocket higher. Next up, we have the double top and the double bottom. These patterns are simpler to spot, but just as powerful. A double top is another bearish reversal pattern. It looks like the letter M. The stock price rallies to a high, pulls back, and then rallies back to roughly the same high again, but fails to break through. That failure to make a new high is a big red flag. When that support level gives way, watch out below. On the flip side, we have its beautiful bullish twin, the double bottom. This one looks like the letter W, and it's a sign that a stock that's been beaten down might have finally found its footing. When you see a W forming at the bottom of a chart for a great company that's been unfairly punished, get your buy list ready. Now for my favorite pattern, the one that gets my blood pumping, the cup and handle. This is a bullish continuation pattern. That means it usually forms after a stock has already had a nice run-up, and it signals that it's just taking a breather before it blasts off for its next big move higher. The cup part forms as the stock pulls back from a recent high. It's not a sharp V-shaped drop, which can be scary. It's a gentle, rounding bottom. The U-shape indicates that the stock is building a solid base of support. It's coiling up, building energy for the next leg up. After the cup is formed and the price gets back near its old high, it typically pulls back one more time. This forms the handle. The buy signal is explosive. It happens when the stock price breaks out above the top of the handle, preferably on a big surge in volume. When you see a perfect cup and handle forming on a stock with great fundamentals, you have to be ready to act. Charts are great, but they're nothing without a great company behind them. You can't just trade patterns blindly. That's a recipe for disaster. You have to do your homework. I say it 1,000 times a night for a reason. You need to invest in real companies with real products, strong leadership, and a solid financial position. So, what are we looking for? It's simpler than you think. First, look for a company with a great story. What do they do? Do you understand it? Can you explain it to a fifth grader? Look for companies that are leaders in their industry, the best of breed. Do they have a brand that people love? A product that's flying off the shelves? A service that everyone is signing up for? It's about finding companies that are dominating their field and have a bright future ahead of them. Next, you have to look at the numbers. Don't be scared. We're only looking at a few key things. Is the company growing its sales and earnings? We want to see revenue going up year after year. That means people are buying more of their stuff. We want to see earnings, profits, going up even faster. That means the company is becoming more efficient and more profitable. Look for companies that are beating Wall Street's expectations every quarter. That's a sign of a winner. Finally, check their balance sheet. You want a company with a fortress balance sheet. That means they have more cash than debt. A company drowning in debt is a red flag. It's a house of cards waiting to collapse. Find a company with a great story, growing sales and earnings, and a strong balance sheet, and you found a potential winner. Now, let's talk about strategy. There are two main camps in the stock market world: day traders and long-term investors. They are playing two completely different games, and you need to know which one is right for you. A day trader is in and out of stocks within the same day. They're trying to scalp tiny profits from small, short-term price movements. It's a high-stress, high-speed game. The vast majority of people who try day trading lose money. I don't recommend it for beginners, period. Long-term investing is the exact opposite. It's the crock pot, not the microwave. You buy shares in a great company that you've done your homework on, and you plan to hold them for years, if not decades. For 99% of people, this is the winning strategy. Let's talk about one of the most beautiful words in the investing world: dividends. What is a dividend? It's a cash payment that some companies make to their shareholders. It's your reward for being a loyal owner. These payments are typically made quarterly. The real magic happens when you reinvest those dividends. Your dividends buy more shares. Those new shares then generate their own dividends, and the cycle repeats. It's a snowball of wealth rolling downhill, getting bigger and bigger on its own. Look for companies with a long history of consistently paying, and more importantly, increasing their dividends year after year. These are called dividend aristocrats or dividend kings. They are stable, shareholder-friendly companies that are committed to rewarding you for your ownership. Ready to make your first trade? Hold your horses. Let's make sure you do it the right way, the safe way. The first rule is to only invest money you can afford to lose. Never, ever invest your emergency fund or money you need for next month's rent. Second, do your homework before you buy anything. Don't buy a stock just because your brother-in-law told you to, or because you saw some anonymous person hyping it on a message board. Pick one or two companies you know and admire. Make an informed decision. Own your choices. Third, diversify. Don't put all your eggs in one basket. You should aim to own stocks in several different companies across different industries. Finally, have an exit plan. Knowing when to sell is just as important as knowing when to buy. Be disciplined, not emotional. So there you have it. The stock market isn't some secret club reserved for the Wall Street elite. It's an opportunity for every single one of us. You now have more knowledge than 90% of the people who are throwing their money at the latest hot trend without a clue. You have an edge. The real test is putting it into practice with discipline and patience. The winners are the ones who don't panic. They stick to their plan. Don't ever stop learning. Stay humble. The market has a way of humbling anyone who gets too arrogant. You can do this. I know you can. Start small, be patient, do your homework, and never, ever let your emotions get the best of you. The power of compounding, the growth of American industry, and your own discipline are the three legs of the stool that will support your financial success. Now go out there and make some money. Booyah!